In this episode, we talk about investments that are stronger for longer. Welcome to the Mullooly Asset Show. I'm your host, Tom Mullooly. This is episode number 26. We had a big debate about who to talk about in episode 26. We finally landed on Dave Kingman, King Kong, only because he wore the uniform twice. But I think he probably struck out more as a Met than all the other people who wore number 26 combined. So what we do in these videos is we get questions from our clients, we get questions from our viewers, and then we talk about them, and hopefully if you've got a topic, get in touch with us, and you may find it on a video real soon. So in this format, Casey's going to read us the question, and then I'm going to try my best to answer it. So what's on tap today?
This question came in from Bram. I've been following you on Facebook and YouTube for a while now, and I have a quick question about relative strength. When viewing a relative strength chart for a single stock to an index, is there a standard percentage box size that should be used?
Kind of a technical question, but the answer isn't quite that technical. Relative strength, with relative strength, we use a 6.5% box chart. That sounds like a really technical answer, but let me explain what that means. 6.5%, if something moves against a yardstick by 6.5%, that's a big move. And we measure not only columns of X's or columns of O's, but we also measure signals, a buy signal versus a sell signal. And we've got videos on our website that you can see, real short ones, 30 seconds, a minute, that cover these type of things. But what we're really looking for is if you are measuring a stock versus, say, the S&P 500, what you want to find are stocks that are not only going up faster, that means they're in a column of X's when you measure it against the S&P, but they're also on a buy signal. So we want to find investments that are going up stronger for longer, because these relative strength signals, according to our friends at Dorsey Wright, these signals tend to last on average about 18 months to 2 years. The first example I can think of that comes to mind is in 2003, crude oil gave a relative strength buy signal in 2003. Now, from 2003 until it gave a relative strength sell signal in 2008, it went up quite a bit. However, there were times when, even though it was on a relative strength buy signal versus a lot of other different investments, it was down. It was down 10%. It was down 15%. But it was still going up faster on a long-term perspective than other investments. So that's really what you're looking for. And unfortunately, if you want to do well, in my opinion, over the long haul, you really need to spend some time learning relative strength or focusing your investments on a relative strength basis. Try to stick with these things that are on relative strength buy signals. They tend to do very well for long periods of time. But in the short term, you're going to find that sometimes you might be lagging the market for 2 months, for 3 months, for a short period of time. But you want to stick with those names that are on relative strength buy signals because they're going to be stronger for longer. That was a great question. Thanks for writing in with that one today. If you've got a question that's been bugging you that you want to talk about, whether it's about investing, about charting, financial planning, about any kind of money management, personal finance, get in touch with us. And don't forget to subscribe. If you're watching this on YouTube, you can hit that red subscribe button or find us on Facebook too. Thanks for watching. Next episode, number 27, we're going to be talking about Old Swanee. See you then.